failure to deliver. And that's when things began to accelerate. So I have always felt that price setting was a privilege that we squandered and we disrespected, and ultimately is being used against us right now by the rest of the world, using the stupid prices that we create through suppression with leverage to stand for delivery. And when there's nothing left to deliver anymore, when you see a massive failure to delivery, which is papered over with cash, it is the same thing, and you will start to rapidly see the world reprice gold and silver in what they believe is the fair, real price, not that make-believe price that is controlled by the futures market.
The global precious metals market is rapidly approaching a historic breaking point as decades of artificial price suppression collide with physical reality. Western financial centers have completely squandered their unique price-setting privileges through excessive paper leverage. Now, international markets are aggressively exploiting these artificially suppressed futures prices by standing for actual physical delivery. Andy Schectman, an esteemed macroeconomic analyst, warns that this relentless physical drain will inevitably expose the extreme vulnerabilities of traditional exchanges. When these institutions face a massive failure to deliver and attempt to cover deficits with forced cash settlements, the paper illusion will completely shatter. The global market will then swiftly bypass these broken derivative exchanges to reprice gold and silver based on their true fundamental value. This imminent structural shift proves that relying on leveraged paper contracts leaves portfolios dangerously exposed to counterparty risk. Securing tangible assets outside of this fractured system is the only way to protect wealth before the market definitively corrects itself. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
You see a glitch like we've seen 4 times in Comex, 2 on the upside, and then the circuit breaker's not working twice on the downside. I think you get closer and closer to a force majeure. If we look at the Comex as an example, you know, they like to when they talk about numbers, first of all, the eligible category is not for sale, but when they talk about deliverable numbers, they typically will take the entire registered category and half of the eligible category, because in theory, higher prices could pull a lot of that eligible metal into the market. What it really means to me is that you're going to need much higher prices to incentivize that metal that is sitting ineligible to move into registered. It's not good. It isn't good, because what it really does through the manipulations of the markets, which, let's just face it, we can't even discount the fact anymore that markets are manipulated, right? And because of that, trust in the institution has been eroded, and that's why you've seen the market in backwardation for so long. And in silver and gold, they should never be in backwardation. They should be in contango, where the spot is worth less than the futures, because the future takes into account storage and the cost of money. Interest costs money to store it, costs money to leave it out there. And the fact that it isn't really is a very big hint to the fact that trust is eroding. When you have a system done, again, that's completely based on trust, as this entire Western edifice is, when the trust starts to crumble and you start to see the big money stand for delivery, and not just stand for delivery, but leave the ecosystem, it should be a major wake-up call to everybody. And I think it doesn't portray for an orderly market when the biggest money on the planet is standing for delivery and moving it out in amounts like we are seeing, where you're talking literally a procession of semi-trucks leaving the safety of the Comex ecosystem, the liquidity of the ecosystem. Now, we would rather pull it out. And let's just say one other thing. When those 1,000-ounce bars are stacked into semis and gone, the minute they're loaded onto the semi-truck, it is outside of the Comex ecosystem. To resubmit it would be a huge cost and a massive time drag, as that they would need to be reassayed and resubmitted into the Comex ecosystem. So they're never coming back. Where are they going? Who's taking them? What's being done with them? That's the big money moving ahead of everyone else. So yeah, it's not a good omen. The concept of futures market controlling the price is something that, when it was built under the right spirit, or with the right spirit, where you're using it to offset risk, to hedge risk. A gold producer mining gold can sell it forward, his production, at an adequate price, removing the risk, and the jeweler or the fabricator who needs the gold and silver, who takes the other end of that contract, is happy that their source is guaranteed. Or a farmer planting a field of wheat in April is concerned about the growing season, but the baker who needs the wheat in September is happy to take the future production at this price. Everyone is happy. You offset risk of your operations. Well, when it becomes a gambling casino, you have problems where big money can control the price of a commodity through the futures market. That's the tail wagging the dog. It shouldn't be that way. And I think it will ultimately move eastward to places like Shanghai, to places like Dubai, to places like St. Petersburg, Petersburg, the new Brinks exchange. All of these places around the globe that value gold and silver perhaps in a different way, and mostly on a cash and carry basis, where it's not a futures price creating it, it's the immediate value for delivery that creates it. So you see some sort of a force majeure or worse, or a failure to deliver in London. And remember, London has no exchange. It's an over-the-counter. It's mano a mano, kind of like eBay, except without the eBay in there and the intermediary to make things right if they go wrong. With Comex, they'll just issue a cash settlement before it gets to that, which is the admission of failure to deliver. And that's when things began to accelerate. So I have always felt that price setting was a privilege that we squandered and we disrespected, and ultimately is being used against us right now by the rest of the world, using the stupid prices that we create through suppression with leverage to stand for delivery. And when there's nothing left to deliver anymore, or when you see a massive failure to delivery, which is papered over with cash, it is the same thing, and you will start to rapidly see the world reprice gold and silver in what they believe is the fair, real price, not that make-believe price that is controlled by the futures market. Leaving Comex, 160% of what was delivered in February is gone. And so what does that mean? Is it accelerating? Is the lack of trust accelerating? Do the people inside this ecosystem who have the ability to stand for possession and move 39 million ounces of silver at $90 an ounce or $85 an ounce, do the math. You're talking billions of dollars getting on a procession of trucks and going where? So the point of it is that yes, this is happening, and the insiders always move before everyone else does. And is that what we're seeing? Don't know. The fact that the media hasn't even sniffed it is pathetic to me, but it to me is an indictment of the entire system and of the Comex and of, what it means for the future in terms of their ability to keep the exchange going without completely blowing up through an erosion of trust and confidence.
The global precious metals market is showing severe signs of systemic instability, highlighted by unnatural backwardation and failing exchange circuit breakers. Decades of artificial price suppression have deeply eroded trust in Western financial institutions. Consequently, massive institutional wealth is now demanding immediate physical delivery rather than holding leveraged paper derivatives. This collapse in institutional confidence is driving an unprecedented physical drain on the Comex, where millions of ounces of silver are being actively removed from the vault ecosystem on semi-trucks, never to return. The traditional futures market, originally designed for legitimate risk hedging, has transformed into a manipulated casino that suppresses true commodity values. As Western exchanges near a critical failure to deliver, potentially attempting to paper over physical deficits with forced cash settlements, the global pricing mechanism is rapidly shifting east. Emerging markets in Shanghai, Dubai, and the BRICS nations are currently establishing fair market values based strictly on physical cash and carry delivery. Once the available registered supply is fully depleted, the fragile illusion of paper derivatives will completely shatter, forcing a historic revaluation of tangible hard assets globally. Let's get back to the interview.
Well, we've been talking about that for a while, London and the U.S. in particular. Even the Shanghai exchange is running tight. You look at Comex, I looked at it yesterday, you could argue they're under visible delivery pressure. Their registered stocks in silver right now, as of yesterday, were 81.2 million ounces. That's roughly 16,250 contracts, 5,000 ounces apiece. But the open interest right now for the month of March is 112,700 contracts. So, you're about 9 to 10 times the amount of paper as there are bars standing behind it. March deliveries have already reached about 6,615 contracts. That's about 33,100,000 ounces. This doesn't prove a Comex failure, but it does show a much thinner registered cushion than, all the headline open interest might suggest. This is the same thing we've seen forever. Let's look at February for a moment. We always talked about less than 1% of contracts stood for delivery. Nearly all of them stood for delivery in February. In fact, 160% of the February delivery, or of what the February delivery could explain, left Comex. Now, the numbers are a little bit, probably slightly off because I didn't see the last settlement day, but a day before February went off the board, about 23, 24, 25 million ounces had stood for delivery. That means coming in from somewhere instead of cash settling, instead of rolling forward to probably the March contract or even May, they stood for delivery. So it was one of the smaller delivery months, actually, and it isn't the primary delivery month as January and March are, but it was nonetheless a robust non-delivery month of about 25 million ounces delivered, but 38 million ounces left Comex. So that's 160% of what was delivered actually left the building. Now ask yourself this question. If a mint box of Silver Eagles is 42 pounds, 500 ounces, who's taking possession of nearly 39 million ounces? Where is it going? Who's running logistics, insurance, the armada of trucks needed to pick it up, and where is it going? Is this the Exchange Stabilization Fund on behalf of the U.S. government, which could, if it were for national security, keep it quiet, need no congressional approval? I mean, I don't know. Could it be? Isn't silver just recently classified critical for national security, strategic? Yeah. So I would say that we are very close to, in both gold and silver, that moment where demand outpaces available supply, but it's even a little deeper in that. And one of the things I wanted to talk about was what happened in GLD last week. Now, it's always, as the media does a great job of, done again, framing it in a crappy light, because $4.2 billion worth of gold left last week out of the GLD account. In other words, in a single week, at all-time high prices, GLD recorded the largest single weekly outflow in its 20-year history, okay? So someone is selling the ETF, right? That's what they want us to think. That they want us to believe that, people are repositioning. But I look at it differently. I look at it as big interests in the U.S. do not want to telegraph their physical demand by bidding loudly in the open spot market, the market that we're talking about, Comex, right? Because they can source GLD shares. The big money would be the authorized participants. They can source these GLD shares or create them and then redeem the baskets, which is 100,000 shares minimum, through their authorized participant channels. They can receive London good delivery bars through the custodial system. In other words, what I'm saying is that this is a lot deeper than people think. And I think that only the authorized participants can redeem the baskets, and they are 100,000 shares minimum each. The fact that they can create and redeem shares in physical metal matters because these large outflows are looked at by the mainstream media as lack of demand, when in reality, as far as I'm concerned, it shows that trust is eroding within the system. And to me, it's that major institutions are sourcing shares and redeeming baskets and pulling bullion out of the ETF inventory without needing a loud public gold shortage headline. It's a big deal. So yeah, whether we see metal coming off of the exchanges or being siphoned out of GLD and SLD by the authorized participants, it's real. It truly is real. And the media does a horrible job of framing that. And I think by the time they do recognize it, it's that little by little, then bang all at once, then they'll report on it. It's too late at that point. And I think that's what you see happening through metal leaving Comex, metal leaving Shanghai, metal leaving the LBMA, metal being pulled out of the ETFs. This is a big deal, and it happens slowly so as not to completely flip over the apple cart. Most people say, well, why not just buy it all? Because the whole thing would end. So they've been doing it slowly. It's accelerating, and it's now becoming a little bit more visible.
The global precious metals market is undergoing a stealthy but massive physical drain. Current data reveals a staggering mismatch on major exchanges, where open interest for paper contracts exceeds available physical silver by nearly 10-to-1. This extreme vulnerability was highlighted recently when 38 million ounces of physical silver were completely removed from the Comex ecosystem, representing 160% of the actual settled deliveries for that period. Simultaneously, major gold ETFs recently recorded their largest weekly outflows in 20 years, shedding $4.2 billion. The mainstream media misinterprets this as a lack of demand, but large authorized participants are actually redeeming massive share baskets to quietly extract physical bullion directly from the vaults. By siphoning this metal off market, major institutions accumulate physical assets without triggering a public price panic. But must follow this fundamental truth: the era of paper manipulation is ending. As institutional wealth silently accelerates its transition into hard assets, the paper illusion will eventually collapse. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.